Hello everyone and welcome back to another video. Have you noticed how tech stocks like Apple and Microsoft have been making headlines for their incredible performance? It got me thinking, what's behind this growth trend? Well, growth stocks, particularly in the tech sector, have been on a phenomenal run. Over the past decade, they've consistently outperformed value stocks, and just to give you an idea, in 2023 alone, growth stocks outpaced value stocks by about 8%. Now, as we look into 2024, this trend is continuing in interesting ways. Despite some economic headwinds, growth stocks are holding the ground thanks to ongoing innovations in the booming tech sector. Today, we're going to dive deep into the Vanguard Growth ETF, or VUG, and see how it can help you tap into this exciting growth. So if you're ready to explore how VUG can supercharge your portfolio, stick around and let's dive in.
Look like a motherfucking no!
So, why do growth stocks matter? Growth stocks have been a driving force behind the stock market's gains for many years. These companies often reinvest their profits to fuel further growth, leading to higher capital appreciation for its investors. This is in contrast to value stocks, which might offer higher dividends but typically experience slower growth. Understanding the dynamics of growth investing can provide significant insights into your investment strategy. With all that being said, VUG was launched on January 26, 2024 and boasts an expense ratio of just 0.04%, making it a cost-effective choice for investors. With over 100 billion assets under management, VUG reflects its popularity and investor confidence.
Man, delete that shit, bro. Delete it.
VUG's top holdings include tech giants like Apple, Microsoft, Amazon, and Nvidia. These companies have seen significant contributors to its stellar performance. For instance, Apple, known for its innovative products and strong brand loyalty, continues to drive revenue diversification and expansion through services and wearables. Microsoft's success in cloud computing with Azure, along with its diversified business model, has also been a major growth driver. Amazon's dominance in e-commerce and cloud computing through AWS and Nvidia's advancements in AI and machine learning further underscore the ETF's strong performance. With these holdings in mind, this ETF is heavily weighted towards the technology sector, which constitutes around 50% of its total holdings, followed by consumer discretionary and healthcare sectors. This heavy tech focus has been a key factor in VUG's robust returns.
You know how I feel. Why would you say that? Like, you put me in such an uncomfortable situation. Like, you know I'm not.
Understanding VUG's sector exposure and top holdings gives us a solid foundation. Now, let's delve into its performance metrics to see how it's fared historically and in recent times. Over the past decade, VUG has consistently outperformed the broader market. From 2013 to 2023, VUG delivered an average annual return of approximately 15%, significantly higher than the S&P 500 average return of about 10%. This performance can be attributed to its focus on high-growth sectors like technology and healthcare. In 2023, VUG surged approximately 27%, benefiting from the tech sector's strength and the rising demand for AI technologies. As of mid-2024, VUG continues to show resilience, with growth stocks maintaining their edge even in a challenging macroeconomic environment.
This is good because I could barely read, so I like looking at pictures better, you know?
To get a better sense of where VUG stands among other growth ETF, let's compare its performance of QQQ and SCHG over 1-year, 5-year, and 10-year periods. As we can see, SCHG has slightly outperformed VUG in the 1-year period, while QQQ has outperformed both VUG and SCHG across the 5-year and 10-year periods. This difference is largely due to QQQ's concentrated exposure to top-performing tech stocks in the NASDAQ 100, which have driven its superior returns.
Fuck T.I., fuck Nelly, fuck 50. I'm like, what do you say fuck me for?
Performance is impressive, but it's crucial to balance that with an understanding of the associated risk and volatility. With a beta of around 1.05, VUG is slightly more volatile than the broader market. This beta indicates that VUG tends to move in sync with the market but with slightly greater fluctuations. This is reflective of its high growth, high volatility stock holdings, and investors should be prepared for larger price swings both upwards and downwards. Investing in VUG carries several risks. Firstly, its heavy concentration in technology makes it vulnerable to sector-specific downturns. Regulatory risks such as increased scrutiny on tech giants could also impact performance. Moreover, high valuations in the tech sector mean that any earnings misses or negative news could lead to significant price drops. Lastly, macroeconomic factors including interest rate changes and geopolitical tensions could influence the performance of growth stocks.
Fuck the bucket ice, man.
While risk and volatility are key considerations, income through dividends also plays a role in the overall assessment of an ETF. VUG's current dividend yield is relatively low, around 0.7% compared to value ETFs, which often have yields above 2%. This is because VUG focuses on more capital appreciation rather than income generation. Growth companies typically reinvest earnings into the business rather than paying out large dividends. While not a primary feature, VUG has shown modest dividend growth over time. The dividends paid by VUG have increased as the earnings of its underlying holdings have grown. This incremental growth in dividends provides a small but steady stream of income for investors.
Take lives. What do you mean by that?
An important aspect of any investment is understanding the costs involved. Let's look at VUG's expense ratio and how it compares to other options. VUG's expense ratio of 0.04% is among the lowest in the industry. This low fee structure is a significant advantage as it allows investors to keep more of their returns. For comparison, many actively managed growth funds have expense ratios above 1%, which can eat into returns over time. By minimizing fees, VUG ensures that more of the portfolio's growth benefits the investor. With cost and income in mind, let's explore the growth prospects that make VUG an appealing option. The ongoing advancements in technology and the increasing adoption of AI are likely to continue driving growth in VUG's holdings. For instance, sectors like cloud computing, e-commerce, and digital payments are expected to see continued expansion. Companies like Microsoft and Amazon are well positioned to benefit from these trends. With continued innovation in tech and other high-growth sectors, VUG is well positioned to benefit from future market trends. Economic indicators suggest a favorable environment for growth stocks as technological advancements and digital transformation drive demand. Furthermore, sectors like healthcare, which are part of VUG's holdings, are expected to grow due to aging populations and increasing healthcare spending. To get a comprehensive view, it's useful to compare VUG with other similar ETFs in the market. Comparing VUG with similar growth ETFs like QQQ and SCHG provides a broader perspective on its performance and strategy. QQQ, which tracks the Nasdaq 100, has a higher concentration in technology and often outperforms in tech-driven bull markets. SCHG, on the other hand, offers a similar low expense ratio but includes a slightly broader range of growth stocks beyond just a large-cap tech names. VUG's performance has been strong, but it's important to consider how it aligns with your investment goals. For example, QQQ might be preferable for those seeking even more tech exposure, while SCHG offers a balance between tech and other growth sectors.
Damn! Put your glasses back on.
Every investment has its pros and cons. Let's summarize what makes VUG a great option and where it might fall short. Starting off with the advantages, at just a low expense ratio of 0.04%, VUG is one of the most cost-effective ways to get exposure to large-cap growth stocks. With such a strong historical performance, VUG has consistently outperformed the broader market and many of its peers, and with its top holdings in leading tech companies, VUG is well positioned to benefit from ongoing technological advancements. Now, looking at the disadvantages, due to its focus on high-growth stocks, VUG is more volatile than the broader market. And with such a low dividend yield compared to value-focused ETFs, it makes it less attractive for income-focused investors. Lastly, the heavy weighting in technology means less diversification and higher risk if the tech sector underperforms. Bringing it all together, let's recap what we've covered and my final thoughts on VUG. In summary, VUG offers a compelling option for investors seeking growth through exposure to leading large cap stocks, particularly in the tech sector. Its low expense ratio and strong performance history makes it attractive, but it's essential to consider the associated risk. The ETF's higher volatility and lower dividend yield might not suit all investors, particularly those looking for steady income or lower risks. However, for those looking for a longer investment horizon and a higher risk tolerance, VUG can be an excellent vehicle for capturing the growth potential of some of the most innovative and dynamic companies in the market. What are your thoughts on VUG? Have you invested in it or are you considering it? Let me know in the comments below, and don't forget to subscribe for more in-depth investment insights. As well, don't forget to follow me on X @MushTGuys. I'll see you guys in the next video.
It was already supposed to happen.